Good morning, Jags. This is Fahad. Today is Friday, January 15th. Let's get started. Only going to briefly touch a stock this morning. And I promise to come back to this with far more details and coverage, whether in chat room or webinar later, as we continue to develop our thesis around this and build more comfort position with exactly where the company is heading and what the stock should do in the coming quarters and years. The stock is Root, symbol ROOT. This is a fairly new IPO. This is an insurtech or insurance. Basically, the company is disrupting the insurance industry. So they classify themselves really as an insurance company, but if you look at the platform, if you look at what company actually offers, it is doing so with incredible use of technology on mobile phones and on the internet and many different ways to be able to process claims, to be able to address markets that are underpenetrated, and as a result, they are getting much cleaner and better attention and everywhere else, and continue to take market share from everybody. It's a $5.2 billion company today, but I believe the future of this company could be significant. So for now, just add this to your watch list, and I promise to come back with far more details and give you more information about it. Here's what you need to know at the high level. The investment thesis for this company is at the forefront of an insurtech wave that is aimed at the large and growing personal lines insurance market, which is estimated to be about $266 billion auto segment. The company is basically disrupting not only the product distribution, which is the insurance policies, but also the product itself, which is through its main category called insurtechs. Specifically, Root's growing leadership is in telematics, which uses data from all the users. That includes drivers, that includes their history on many different things, and the car itself. It combines all the data analytics from all channels to better evaluate risk, and it promises to drive down loss costs and thus make auto insurance more profitable and affordable for a wider range for consumers. And this is what I mean, so for some reason, for most others, and I don't even pay attention, for example, for myself as to how much I pay on an annual basis for my insurance. But for some reason, for many people, this may come as a surprise as to how costly auto insurance could be depending on the car they're driving. And particularly for the enterprise, if you take out an enterprise lease, even on a simple sedan, your insurance cost could run easily up to $1,500, $1,800 per year, which seems abnormally high, sometimes amounting to as much as 5 to 10% of the value of the car itself per year. There's many reasons for that, and eventually when I give you a much more detailed look on this stock, I will dive into those reasons. And what this company is doing is it's eliminating those layers of processes that don't need to be there, make it far more cost efficient, and provide and collect the data from all the angles to provide a way for consumers to lower costs for everybody. Basically, far better use of technology than anybody else. There's an initiation note that is out from Truist analyst a while back ago. And in this note, they talk about, I quote, Root's data capture and analysis provide unique inputs for underwriting and pricing. Independent evaluation suggests Root Analytics outpaced the industry third-party solution by 10 times, while engagement through the app has already given the company an edge in claims handling cost. We believe these advantages should allow Root to capture profitable share in a highly fragmented market over time. So there you have it. I should also mention that the management that runs this company is quite competent, and they're actually engineers in many ways themselves. So for example, the CFO, Dan Rosenthal, and the vice president of the data sciences, Matt Bonig-Darpur, and the director of investors relation, Joe LaRoche. All of these guys have significant deep knowledge into the data analytics business, and that's where they're making the difference. Lastly and quickly, stealth revenue growth over here. So if you just look at the last 2 years, for example, at the beginning when the company was formed in the first quarter of 2019, that's how far back we have the history. The company did quarterly revenues of only 41 million. Then in the second quarter of 2019, it was 63 million. Then 80 million, then 107 million, 124. And then from there, it just continued to track higher and higher. On a year-over-year basis, we are now looking at the fiscal year 2022 revenues will be about 345 million, which would equate to approximately 22-23% growth on a year-over-year basis. And so some may say this is an expensive stock based on enterprise value, trading at almost 20 times sales, but it also happens to be a disruptor. So something to take note. For now, add this to your watch list. I'll be back into this one with more details in the future. That's it from me. Let's go to Jay.
Morning, everyone. So today, just providing an update on Monster Beverage, ticker MNST. This is one of the stocks that I recently covered in Weekend Research, and as I mentioned in that note, the company was holding an investor meeting on Thursday, so after the close yesterday. This morning, we've got Citigroup raising their target to 99, Deutsche going to 102, Truist to 105, and Credit Suisse to 110. Not much action, though, pre-market yet, but some of the takeaways from that event. Number one, the co-CEO announcement. They announced that Hilton Schlossberg, who is the current president, COO, and CFO, will become co-CEO. Not much to read into this. Analysts basically say it's not surprising considering this individual has largely acted as co-CEO already since him and the other CEO, Rodney Sachs, basically when they acquired the company, they've been sort of acting, as a 1-2 punch. And this announcement shouldn't have any impact on the company's current strategy. Now, in terms of product innovation, they announced a number of different drinks. They're going to be releasing an Ultra Gold later this month. I covered that briefly in the Weekend Research note. 3 new Rain body fuel flavors, a Nitro Super Dry coming out next month, a packaging redesign and a formula tweak for Monster Assault, a new flavor and package redesign for the Monster Rehab line early this spring. The company also announced plans to sell 12-ounce cans across 4 different SKUs in the convenience store space. According to Stifel, this 12-ounce can represents an opportunity for Monster to broaden its appeal away from the traditional energy demographic and should prove to be incremental to sales. Noted that during the presentation that it has agreed with a majority of their C-store partners for these 12-ounce cans, so there should be incremental shelf space coming for them. And then finally, on the alcohol hard seltzer initiative, the company said it was continuing to evaluate an alcoholic offering and said that it would comment more definitively on its next earnings call. But Stifel continues to think this company is strongly considering an introduction of an alcoholic seltzer, considering they have a recent trademark filing, some job postings, and the creation of a related LLC. So the next catalyst for this company is going to be its earnings call. I don't believe the date has been confirmed yet, but it should be sometime next month.
Very interesting update. The important thing for me, I think, from that alcohol offering is that I think this is going to be significant success because 2 things really. One is simply the fact it's a natural extension of the company's product offerings, right? And I don't believe it's fully baked into consensus view, especially because the company has not put a timeline on it, and we're going to probably start hearing it in the second quarter. So it couldn't possibly be in the consensus view. Mm-hmm. And the second thing is the Monster beverage is so popular with the young, right? With the youth.
Yeah.
That's their target market. So when they come out with one of some sort of seltzer, I think that's going to fly. I think it's going to be a very important catalyst for the stock. And so if that's the catalyst in the second quarter, this is one to watch because I think that it's going to be when that announcement comes, it's going to be, that's when you start to basically put the projections together based on same thing as SAM, right? and some of the other stocks that have been very popular. Stock should be a steady grind higher, I think, over the course of the entire year with minor pullbacks along the way, like the way we saw recently. So thanks for that update.
Yeah.
Very good one. Let's go to Chronicle.
Morning. Just one minor update today on Channel Advisor, symbol ECOM, which was a long idea that I presented in conversations on December 9th. The stock's been up nicely since then, and they're due to report sometime in early February. So as everyone knows by now, Needham has been holding their annual growth conference this week, and yesterday they hosted a chat with Channel Advisor's CEO and CFO. And there are a couple takeaways from their notes summarizing this meeting. So first off, consistent with what I said when I was pitching this idea, management highlighted that they are continuing to see signs that e-commerce GMV is continuing to go from strength to strength rather than normalizing to pre-pandemic levels. And as such, the company is looking to invest incrementally in their GTM and their customer service improvement, which I detailed on December 9th. And they've also disclosed that their sales rep compensation plans have been adjusted to incentivize the onboarding of branded customers and cross-selling, which are the areas where management will be focusing on in 2021. And so in short, Needham here is expecting continued strong adoption of Channel Advisor's marketing solutions this year, with the main drivers being the cross-selling of new functionality and increased focus from retailers in digital channel expansion. And lastly, they also note that as the sales and customer service side of the business improves, they see the unaccounted potential for bookings contribution from branded customers to increase not just this year, but also beyond. So that's basically the entire note. Now, one thing I'm surprised they didn't talk about with management is whether or not tough comparisons for e-commerce even matter for this company, because here's my thinking. This company, Channel Advisor, they're providing online marketing and advertising solutions. They are not the sellers, so they're not directly exposed to the tough comparisons. And here's where I'm being a bit contrarian. First off, I do agree that e-commerce is going to face tough comparisons. I have no problems with that thinking, but what I believe consensus has yet to pick up on is that because of tough comparisons, online vendors are possibly going to be pressured into spending more on marketing and advertising this year because of the intensified competition. And so I think companies like Channel Advisor could well end up surprising with continued strength this year rather than succumbing to so-called tough comparisons. So as a side note, I think being long an online advertising solutions company and at the same time, if you want to hedge, shorting an online vendor because of tough comparisons, I think that could make a nice relative trade this year if you're into that sort of portfolio strategy.
Yeah, thanks for that update. Excellent stuff. ECOM has been very steadily breaking out. Volume hasn't been very high behind this, but very clean breakout from this wedge. And at this point, this is actually starting to clear through all of this resistance level that we saw back in October through 18 to $18.50. I believe this thing is going to go to mid-20s. I don't know if that's your price target, if that's where you believe it's going to head, but I think over the course of next couple of quarters, this thing is going to go towards mid-20s. And as far as the advertising trends are concerned, you know, we keep a pretty good eye on the channel checks and any kind of decelerating trends or accelerating trends. And frankly, everywhere I look, and if I watch the commentary as well, whether it comes from the advertising is spent on Snapchat to Pinterest, as well as if we go and look at the some of the other favorites that we have, such as right here, Trade Desk, and some of the other ones that have been beneficiary of those trends. We have not seen any kind of decelerating trends in any of those. If there's a regulatory risk, that would be a completely different ball game, but we are just simply not seeing it, and at least I have not seen it yet. So I agree with that entire thesis. And as a reminder to everybody, folks, the bull case was presented on December 9th in Conversations. Feel free to find this on Jaguar Media to refresh your view. That's it from us, and we will see you in the chat room shortly.